There's a moment that finds almost everyone. A kitchen table late at night, a phone calculator, and a number that doesn't work. For most people, it arrives around 45. In the next few minutes, I'm going to give you the 10 money rules that Moment teaches, so you can learn them the cheap way, right now, at whatever age you're at. I once watched a man sit in his truck outside a grocery store, checking his banking app before he went in, deciding in the parking lot which aisles he was allowed to walk down. He made decent money. He worked hard. Nobody had ever taught him the rules, because nobody teaches them, not school, not work, not the bank that profits when you don't know them. So here they are, 10 rules, real numbers in every one. And number 9 is the one that quietly costs people the most, because it looks like nothing at all. Rule 1, pay yourself before anyone else gets paid. Most people run it in this order. The paycheck lands, the bills eat, the weekend takes a bite, and whatever survives gets saved. Which means nothing gets saved, because survival is not a strategy. Flip it. The day money arrives, the first $100 leaves automatically into an account you don't look at, before rent, before the phone bill, before you. A warehouse worker doing this on a modest wage stacks $1,200 a year without feeling a single dramatic sacrifice, while his coworker earning the same money ends December with a shrug. The difference isn't income, it's order of operations. The first $100 of every paycheck should already have a job. Set up the automatic transfer tonight, even if it has to be $25 instead of $100. The amount matters less than the order. Rule 2. Find the money you never decided to spend. Quick question, what did you spend last Tuesday? Not roughly. Exactly, if you can't answer, you're not alone, and that's the problem. The average person bleeds $5, $6, $7 a day on things they never actually chose. The subscription from 2023, the delivery fee, the upgrade tapped without thinking. $6 a day sounds like nothing. It's $2,190 a year. That's a used car repair fund. That's a flight in a week somewhere. And to be clear, this is not a lecture about coffee. Buy the coffee if you love the coffee. The rule is simpler than that. Every dollar should be spent on purpose. Broke isn't always an income problem. Sometimes it's a leak. Tonight, open your statement and hunt for one payment you forgot existed. Cancel it. That's the whole assignment. Rule 3. Build a $1,000 wall before you build anything else. Watch how a small problem becomes a big one. A $700 car repair hits a person with no cushion. It goes on a card at 24%. Minimum payments turn $700 into more than $2,000 over the years it takes to clear. And worse, that card is now the plan for every future surprise. The person with $1,000 sitting in a boring account pays the mechanic, grumbles, refills the fund, and moves on with their life. Same repair. 2 completely different futures. An emergency fund doesn't earn much interest, and that's fine. That's not its job. It earns you the word no. No to the card, no to the payday loan, no to panic. If you have nothing saved, this comes first. Before investing, before extra debt payments, before everything, $1,000, that's the wall. Start stacking bricks. Rule 4. Treat high-interest debt like a fire, because that's what it is. $8,000 on a credit card at 24% costs about $160 a month in interest alone. That's $5.25 a day, every day. Walking out the door before you're even awake, not touching the debt itself, just renting it. People will tell you debt is normal, and some debt is a sane mortgage, a car note you can actually afford. But interest above 10% is a house fire, and you don't budget around a house fire. You put it out. List every balance by interest rate, highest first, and throw everything you can at the top of that list while paying minimums on the rest. Interest you pay is your future working someone else's shift. End the shift. Rule 5. Earning more will not save you, because income is not wealth. 2 coworkers, both on $65,000 a year. 10 years pass. One has $90,000 invested and drives a paid-off sedan. The other has a truck payment, a bigger apartment, 3 subscriptions per streaming mood, and $312 in checking. Same paychecks, opposite decades. The mechanism is simple. Every time the second guy's income rose, his lifestyle rose to greet it. So he stayed exactly 1 paycheck from zero at every salary he ever earned. There are people making $200,000 a year who are broke on a Tuesday. Wealth isn't what arrives, it's what remains. So make yourself one promise before the next raise ever shows up. Half of every future raise is invisible. It routes straight to savings before your lifestyle finds out it exists. You'll still feel richer. You'll actually be richer too. That's 5 rules, and notice they were all about defense. Plugging leaks, killing fires, holding the line. The second half is different. The second half is offense. How money you already have starts earning money while you sleep. And rule 9 is still coming. The quiet one, the thief in the room right now. Rule 6. Start ugly. Start now. Time beats amount every single time. Here's the math that changes people. $200 a month invested in a plain, boring index fund, averaging around 7%. Start at 25, and by 65, that's roughly $520,000. Start at 35, same amount, same fund, and it's about 244,000. 10 quiet years, $250,000. Nobody feels those years going by, which is exactly why almost everybody loses them. Now, if you're hearing this at 45 and your stomach just dropped, stay with me because the math has good news for you too. 20 years of that same habit still builds over $100,000. The window doesn't slam shut. It narrows, and 10 years from now, you will be 10 years older either way. The only question is whether the money grew while it happened, which means the worst possible response to starting late is starting later. You don't need a perfect portfolio. You need a start date, and the only one that pays is today. Rule 7. Never put money into something you can't explain in one sentence. A friend of mine paid $4,000 to learn this. A coworker showed him a coin that was, quote, definitely about to go crazy. He couldn't have told you what it did, who built it, or why it would grow. But the coworker sounded certain, and certainty is contagious. The coin went to almost nothing. The coworker stopped mentioning it, and my friend started calling that $4,000 his tuition. One filter would have saved him. If you can't explain an investment to a 12-year-old in one sentence, what it is and why it should grow, you're not investing. You're gambling on someone else's confidence. If you can't explain it, you don't own it. It owns you. Rule 8. Everything you buy has a second price, and the tag never shows it. A $30,000 car is not a $30,000 decision. Add the loan interest, the insurance jump, the tires, the services, the little repairs that stop being little, and 5 years later, that car has really cost closer to $42,000. The boat has a marina fee. The bigger house has bigger everything. Even the free puppy eats. None of this means don't buy things you love. It means see the whole bill before you sign. So before any major purchase, run one question. What does this cost per month to keep, not just to get? Write the number down. Half the time, the second price will talk you out of what the first price talked you into. And that conversation is worth thousands. Rule 9, the quiet one. Watch the fees because 1% can eat a quarter of your money. This is the rule I promised you at the start, and it hides well for a reason. 1% sounds like a rounding error. It's the kind of number an advisor says with a smile, the kind buried on page 9 of a fund document. But go back to Rule 6, $200 a month for 40 years. At 7%, you finish around $520,000. Give away 1% a year in fees, so you compound at 6 instead, and you finish near $400,000. That polite little 1% just took roughly $120,000, almost a quarter of everything the money would have built. Fees, whisper, compounding shouts. You have to listen to both. This week, look up the expense ratio on anything you own. If it's above 0.5%, ask it out loud what exactly it's doing for you. Rule 10. Your income is the engine. Never stop tuning it. Every rule so far manages the money you make, but the size of the river matters too. And there's a part of it almost nobody prices correctly. A raise is not a one-time payment. A single $5,000 raise at 30 doesn't just pay you $5,000 once. It raises the base that every future raise, every bonus percentage, every job offer gets calculated on for the rest of your career. Played forward across 30 working years, that one negotiation is realistically worth well over $100,000, which means the scariest conversation in your calendar might be the best paid hour of your decade. So build the case. Track your wins for 90 days, learn one skill your workplace visibly lacks, then ask, in a scheduled meeting with numbers, not in a hallway with hope. The market pays for value it can see. Make yours visible, 10 rules. Pay yourself first, spend on purpose, build the wall, put out the fire, keep what you earn. Start now, however ugly. Explain it or don't buy it. Price the second bill. Guard against the quiet thief and keep tuning the engine. Now remember the man in the truck outside the grocery store? Here's the part I didn't tell you. That was years ago. He picked 2 of these rules, just 2, and worked them like a job. The wall first, then the fire. Today, he walks into that same store without checking his phone, and if you asked him what changed, he wouldn't say his income. He'd say the order of his decisions. Now for the honest part, because you've probably noticed these videos love to promise transformation by Friday. 10 rules is a lot, and if you try to install all 10 this week, you'll run all 10 for about 9 days and then quit. That's not a character flaw, that's just how humans work. So don't. Pick one, the one that stung when you heard it. If your stomach tightened at Rule 4, the fire is your rule. If Rule 6 made you do math about your own age, time is your rule. One rule, worked properly, will pull 2 or 3 others along behind it. That's how these compound the same way the money does. And if money is genuinely tight right now, if the $100 in Rule 1 made you laugh, then your version of these rules starts smaller, and that's fine. $10 ordered correctly beats $100 ordered wrong. The rules don't care about the size of the numbers. They care about the direction. And let me say this plainly for anyone who came here feeling behind. The fact that nobody taught you this wasn't your fault. Staying untaught from tonight on would be. You're not too late. You're just finally paying attention, and attention, applied to money, is the whole game. So here's the move. In the comments, write the number of the rule you're starting with and today's date. nothing else. Then come back in 30 days and reply to your own comment with what changed. Thousands of people scroll past videos like this every hour. The ones who write the number are the ones who come back different. Be one of them. Pick your rule. Start tonight.